In this video clip, I look at a further step in the final phase of calculating the NCIs, and that is to record the effect of intergroup consolidation entries on the NCIs. Now, once again, I'm using question 1811, and we're now busy with the first intergroup transaction. Inventory was sold by the subsidiary to the parent company for an amount of $40,000. The markup is 25% on cost of sales. And at the end of the financial year, the parent company still had inventory to the value of $2,000 that they've acquired from the subsidiary. So from that intergroup transaction, there's a balance of $2,000 left. Now, from previous studies on intergroup transactions, you know that if there's profit in closing inventory, unrealized profit from the group perspective, we have to reverse the sales, adjust the cost of sales so that it reflects the cost of sales based on the original cost of the inventory, and also adjust the inventory value to eliminate the unrealized profit that sits in that asset. So that is what's done in the first entry year. So it's the standard elimination of unrealized profit on this resulting from the sale of inventory between two companies. So we were told that the sales was $40,000 when the subsidiary sold it to the parent company. So that's always a fairly easy adjustment where we just reverse the sales on group level. We were told that the markup is 25% on cost of sales. So if cost of sales is 100, markup is 25, then sales, the selling price would be 125. Now the inventory has been recorded in the parent's company at what it was sold at in the subsidiary. So the figure of inventory is reflects the sales price from a group perspective. So if we want to calculate the unrealized profit that sits in that inventory, and the inventory has a value of $2,000, we have to say the profit is 25 over what the sales amount was, or the sales value, which currently is $2,000. So that gives us a figure of 400. So our inventory has to be reduced by 400 to ineffectively eliminate that unrealized profit. In this question, you didn't have any further information to calculate the cost of sales on its own, so it's sufficient then just to calculate it as the balancing figure in this entry, because this is a standard entry that we pass. Okay, because we adjusted the value of an asset, there's a deferred tax consequence for future tax benefits because the inventory value has been reduced, and the tax effect of the unrealized profit that's reversed, we also have to reverse the income tax expense. Okay, so that's fairly standard in terms of our intergroup transactions. What we then add to it, if there's NCIs, is that these accounts all form part of the profit figure of the subsidiary. So if we, because it's the sales in the subsidiary, cost of sales of the subsidiary, and the income tax expense of the subsidiary. So if we adjust those balances on a group level, it means that we also have to adjust the NCIs. So that's going to change the profit on a group level. It's going to reduce our earnings for the year because we reverse a profit that was included. Because there's a reduction in earnings, the NCI has to move in line. So the NCI is going to reduce with 25% of this reduction. So the net effect of these three is $280. 25% of that is $70. So if our earnings have dropped by $280, then we want to see that the NCI drops by 25% of that $70. And the adjustment for all our NCI movements are made against the share of profit line item.